For more now on financials, specifically Morgan Stanley, Goldman Sachs. David Trone is a senior analyst at Fox-Pitt, Kelton, and he joins us now with his perspective. Welcome, David.
Thank you.
1 year later, do you think the financial industry landscape has changed for the better to avoid another crisis?
Well, yeah. I mean, every time Wall Street gets into times like these, we do learn from our mistakes. We may not conceptually get rid of risk and greed. Those are the two driving factors that are ever present. But the specific design flaws that create downturns and product difficulties, whether it be junk bonds in the late 80s or derivatives in 93 or now the mortgage mess, these are things that smart people in those units are trying to figure out how to redesign and make sure it doesn't happen the next time. The country was hurt, but also individuals lost a lot of money working for these firms. So obviously it's not just altruistic. It's people looking to avoid the pain personally next time.
Zeroing in here on some of the giants, Morgan Stanley has gone with this strategy of taking less risk, getting a much bigger chunk of revenue coming from brokerage, though not a capital-intensive business, of course. So how is this strategy going to affect Morgan Stanley stock price versus Goldman Sachs?
Well, the regulatory changes, the increased capital requirements will really affect lenders. It'll make lending a less profitable business, and Goldman and Morgan Stanley are not substantially in that business. The cap on leverage could impact their returns and profits during the next big credit cycle, because credit cycles are when leverage are used. In the equity cycles, a la 95 to 2000. You don't need as much leverage, so that wouldn't affect their profitability in an equity cycle.
Could Morgan Stanley, though, beef up its institutional business, or has it lost a lot of talent with Mac's departure?
Well, I think on the institutional side, Morgan Stanley has been one of few firms that has actually kept the franchise in pretty good shape in terms of talent loss. You're talking Citi, UBS, some of the big universal banks. J.P. Morgan, Morgan Stanley, and Goldman Sachs have been pretty good at keeping their top talent and also paying them reasonably well. So I think it's really just a question of James Gorman, the new CEO. How much risk does he want to take?
Speaking about the executive compensation, how do you think that's all going to sort out at the end of the day? What's the solution?
Well, I think executive compensation, the guys at the top will almost certainly see some restrictions. I think that's fitting, because let's face it, the risk failure of this crisis was driven from the top. It wasn't the guys at the rank and file that were making the decisions that caused the problems. So I think the rank and file are going to make out a lot better than a lot of the journalists are suggesting and the politicians are threatening. I think maybe your $30 million a year trader might have some pressure, but the average Wall Street person makes a few $100,000 a year, and I don't think that's under any risk at all.
Getting back to strategies, I'd like to address Goldman Sachs. They got right back into proprietary trading as soon as it could after the crisis. Do you expect it to continue to ramp up risk from here?
Well, when we talk about risk, we got to be real careful about generalizations. There's very many different types of risks. The kind of risk that got us into trouble in the crisis was the balance sheets ballooning with way too much leverage and securitization product being put on the balance sheet, and then it fell in value. The everyday trading, customer flow trading, is something that Goldman and Morgan Stanley does very well at. They almost never lose money over the course of a quarter, and that's the kind of thing you want to see them do. Proprietary risk, in the purest sense of betting against the market, that's something that they tend to do, but they don't really do it in the magnitude that would create any kind of losses, the likes of which we saw in the securitization bust last year.
David, are the banks still securitizing risky loans? How big of a business does this continue to be?
Well, securitization was a real big business for, the UBSs, the Citis, the Lehmans and Bears. Of course, the latter two no longer with us independently. It was not a huge business at Goldman Sachs. Morgan Stanley, they were kind of middle of the road. So, it definitely takes a little bit of profit away from those two, but they were not the real big players in the business, and that's why they're still around, by the way.
And then characterize how big of a liability toxic assets continue to be.
Toxic assets, are still a very big deal at, Citi and to a lesser extent Morgan Stanley. Not an issue at all at, J.P. Morgan or Goldman Sachs.
All right. So if we had to sum it all up, looking at the landscape today, who's doing it best? From a stock, let's say from a stock buyer's perspective, if you were just getting into investing in financials these days, who would you buy?
Well, they're all kind of rich at this point. There's been a very big rally. Investors have gotten pretty excited about what the world will look like after the bad assets are kind of, dealt with. But so I think the stocks are pretty heavily valued at this point, and we're not real excited about any of the real big names like Citi or J.P. Morgan or Goldman or Morgan Stanley. But just quality-wise, if you look at earnings power, Goldman is the best. They missed the worst of the problems in the financial crisis, and they're coming out of the box pretty aggressively, as is J.P. Morgan.
And we'll have to leave it there. David Trone of Fox-Pitt Kelton, many thanks for your time and your insights today.
Okay, thank you.